If you've ever felt like crypto conversations sound like a different language, wallets, chains, gas fees, halvings, you're not alone. For most beginners, the hardest part isn't buying crypto. It's knowing where to start without feeling like you're walking into a trap. In 2026, crypto is no longer the Wild West it once was, but it's also not a guaranteed shortcut to wealth. It's a tool. And like any tool, it can either help you build something slowly or hurt you if you use it without understanding how it works. This video is not about hype. It's not about getting rich overnight. And it's definitely not about chasing the next viral coin. This is a calm, beginner-friendly guide for normal people who want to understand crypto in a safe, realistic way in 2026. What it is, why it exists, and how to approach it without risking your financial stability. Let's start with the most basic question. What is crypto, really? At its core, cryptocurrency is digital money that runs on technology called blockchain. Instead of a bank or government controlling a ledger of transactions, the blockchain is a shared public record that thousands of computers around the world help maintain. When someone sends crypto, that transaction is verified by the network and permanently recorded. No single company owns it. No single person can quietly change the numbers. For beginners, the key idea is this: crypto removes the middleman. There's no bank approving transactions, freezing accounts, or limiting transfers based on location. That's the promise. But with that freedom comes responsibility. In crypto, you are the bank. If you lose access, make a mistake, or trust the wrong person, there's often no customer support to undo it. Now, in 2026, crypto looks very different from how it did a few years ago. Earlier cycles were dominated by speculation, people buying coins simply because prices were going up. Many newcomers entered during bull markets, made emotional decisions, and learned painful lessons when prices crashed. That history matters, because it shapes how beginners should approach crypto today. By 2026, regulations in many regions are clearer. Major exchanges operate more like financial platforms, with identity verification, security standards, and consumer protections. Institutional investors, pension funds, asset managers, even some governments are involved. That doesn't make crypto safe in the traditional sense, but it does mean the space is more mature, more transparent, and less chaotic than before. However, maturity doesn't eliminate risk. Prices still move sharply, scams still exist, and misinformation spreads faster than facts. That's why beginners need a framework, not just instructions. So, before we talk about buying anything, let's talk about why people use crypto at all. Some people use crypto as a long-term investment, similar to buying stocks or gold. They believe certain networks will become more valuable as adoption grows. Others use crypto for practical reasons, sending money across borders faster, holding value outside unstable currencies, or interacting with digital applications that don't rely on traditional banks. And some people are simply curious, wanting exposure to new technology without fully committing. All of these reasons are valid. What's dangerous is entering crypto without knowing your own reason. If you don't know why you're here, you'll follow someone else's agenda, usually a loud voice on social media with something to sell. For absolute beginners in 2026, the most important mindset shift is this: crypto is not a lottery ticket. It's closer to learning a new financial system. That means starting small, moving slowly, and prioritizing understanding over excitement. Let's also clear up a common misconception. Crypto is not just Bitcoin. Bitcoin was the first and remains the most well-known, but the crypto ecosystem includes many different networks with different purposes. Some focus on payments. Others enable smart contracts, self-executing programs that run on the blockchain. Some are built for speed, some for security, some for privacy. As a beginner, you don't need to understand all of them right now. In fact, trying to understand everything at once is a recipe for confusion. What you do need is a mental map, a basic understanding of categories, risks, and trade-offs. Another important reality in 2026 is access. Getting started with crypto is easier than ever. You can buy small amounts with a bank card, use beginner-friendly apps, and store assets with user-friendly wallets. Ease of access is a double-edged sword. It lowers barriers, but it also tempts people to skip learning and jump straight into action. That's why this series is structured the way it is. We'll start with foundations, then move into mistakes, then strategies, tools, and finally the emotional side of investing, which is where most people fail, even when they have good information. Before we end this first part, let's address fear. Many beginners are scared of crypto because they've heard stories of hacks, lost passwords, and sudden crashes. That fear is not irrational. Crypto demands respect, but fear should lead to preparation, not paralysis. The goal is not to eliminate risk, that's impossible. The goal is to manage risk in a way that aligns with your life, your income, and your long-term goals. You don't need to bet big. You don't need to be early. You don't need to impress anyone. Now that we've built a basic foundation, it's time to talk about the part most beginners try to skip. Mistakes. Not theoretical mistakes, real ones. The kind that quietly drain accounts, damage confidence, and make people swear off crypto forever. Not because crypto is useless, but because they entered it unprepared. In 2026, beginner mistakes haven't disappeared. They've just changed shape. The language is smoother, the apps look safer, and the marketing is more polished. But human behavior is still the same. Let's walk through the most common mistakes step by step, using realistic scenarios you might recognize yourself in. Mistake number 1. Entering crypto with no clear plan. One of the most common beginner stories goes like this. Someone hears about crypto from a friend, a headline, or a viral post. They download an app, buy a coin they've heard of, and then, wait. No plan, no time frame, no idea what success or failure looks like. A week later, the price drops. Panic sets in. They check charts every hour. Then it rises slightly. Relief. Then it drops again. Eventually, stress takes over, and they sell at a loss just to be done with it. The problem here isn't the market. It's entering without a plan. Crypto prices move fast. Without a clear reason for buying, long-term holding, learning, diversification, you'll react emotionally to every movement. In 2026, with 24/7 markets and constant news, this mistake is more dangerous than ever. Mistake number 2, investing money. You can't afford to lose. This mistake is old, but it still ruins beginners. Someone uses rent money, emergency savings, or borrowed funds because they feel pressure to not miss out. Maybe they believe prices will never be this low again. Maybe they think one good trade will fix financial stress. Here's the reality. Crypto is volatile. Even strong assets can drop 30–50% in short periods. If that money was needed for real life, stress will force bad decisions. You won't think clearly. You won't stick to logic. In 2026, safer platforms make it feel like crypto is less risky than it actually is. But volatility hasn't gone away. Beginners must treat crypto money as risk capital, not survival capital. Mistake number 3, chasing hype and social media. Signals. This is one of the most destructive habits. A beginner scrolls through social media and sees confident claims. This coin is about to explode. Last chance before liftoff. Smart money is buying now. What beginners don't see is timing. By the time something is viral, early buyers are often already taking profits. Newcomers become exit liquidity without realizing it. In 2026, hype is more sophisticated. Influencers use charts, technical language, and storytelling to sound credible. Some truly believe what they say. Others are paid to promote. As a beginner, you cannot tell the difference easily, and that's the danger. A realistic scenario. You buy a trending coin after a big price jump. It stalls. You hold, hoping. Weeks pass. Interest fades. The price slowly bleeds downward. You sell out of frustration. The lesson feels like crypto is a scam, when the real lesson is hype is not a strategy. Mistake number 4, overtrading and constant switching. Many beginners believe activity equals progress. They buy one coin, then sell it for another, then switch again. Each move feels like doing something smart. In reality, frequent trading increases fees, taxes, and emotional fatigue. It also leads to second guessing. In 2026, with advanced apps and instant execution, It's easier than ever to overtrade without realizing the cost. A common pattern looks like this. Coin, A drops, panic sell. Coin B is rising. Buy late, coin B corrects, panic sell. Repeat. This cycle slowly erodes capital and confidence. Mistake number 5. Ignoring security basics. Some beginners focus entirely on price and ignore security. They reuse passwords. They click links in emails. They connect wallets to random websites offering free rewards. In 2026, scams are cleaner and more professional. Fake apps look real. Messages sound official. And because blockchain transactions are irreversible, one mistake can be permanent. A realistic scenario. A beginner receives a message claiming to be from an exchange, warning about suspicious activity. They click a link, enter credentials, and within minutes, funds are gone. No hotline, no reversal. This isn't rare. It's one of the most common causes of losses for beginners. Mistake number 6. Expecting certainty in an uncertain system. Many beginners ask, is this coin safe? Or, will this definitely go up? These questions come from a desire for certainty. Crypto doesn't offer that. In 2026, even well-established projects face competition, regulation changes, and technological risks. There are no guarantees, only probabilities. Beginners who accept uncertainty early tend to make calmer, more rational decisions. Those who demand certainty usually fall for confident-sounding promises that don't hold up. Mistake number 7. Quitting after the first loss. Finally, many beginners leave crypto after a small loss, convinced they aren't good at it. But losses are part of learning any financial system. The difference between those who grow and those who quit is reflection. Did you lose money because the market moved? Or because you ignored rules, followed hype, or acted emotionally? Now that we've seen where beginners often go wrong, it's time to talk about what actually works. Not shortcuts, not secrets, just simple, repeatable strategies that help beginners survive long enough to learn, and learn enough to make better decisions over time. In 2026, the most successful beginners are not the smartest or the luckiest. They are the most disciplined. They follow basic rules, even when emotions push them to break them. This part is about those rules. Let's start with the most important one. Rule number 1. Start small on purpose. Many beginners believe starting small means thinking small. In reality, starting small is a strategic advantage. When the amount invested doesn't threaten your lifestyle, your brain stays calm. You can observe price movements without panic. You can make mistakes without regret. A realistic beginner approach in 2026 might look like this. You decide on an amount that, if lost entirely, would not affect your rent, food, or sleep. Not probably okay, truly okay. That amount becomes your learning capital. Starting small also changes how you measure success. Instead of asking, how much did I make? You ask, what did I learn? That mindset is rare and powerful. Rule number 2, favor simplicity over variety. Another beginner trap is over-diversification. Buying many coins feels safer, but without understanding each one, it actually increases confusion. In 2026, a safer strategy for beginners is focusing on a small number of well-established assets. These tend to have long operating history, strong security records, high liquidity, clear use cases. This doesn't mean they won't drop in price. It means they are less likely to disappear overnight. A simple portfolio is easier to monitor, easier to understand, and easier to manage emotionally. Complexity can come later, after experience. Rule number 3. Use time as your ally. Beginners often focus on timing the market, buying at the perfect moment. In practice, even professionals struggle with this. A safer beginner strategy is spreading purchases over time. Instead of investing all at once, you invest smaller amounts at regular intervals. This reduces the emotional pressure of getting the timing right and smooths out volatility. In 2026, many platforms make this easy with recurring buys, but the tool is less important than the mindset. Consistency beats prediction. Rule number 4. Separate learning from speculation. Learning and speculating feel similar, but they are not the same. Learning means observing how assets behave, understanding how wallets work, and seeing how news affects markets. Speculation means chasing short-term price movements for quick profit. As a beginner, your primary goal should be education through exposure, not profit through prediction. A healthy approach is to label your actions mentally. This small amount is for learning how transactions work. This long-term position is for holding, not trading. This separation prevents you from turning every decision into a test of intelligence or self-worth. Rule number 5. Write down your rules before you buy. This sounds simple, but very few beginners do it. Before buying anything, write down why you're buying, how long you plan to hold, what would make you sell, what would not make you sell. When prices move, emotions will try to rewrite your logic. Written rules anchor you to your original reasoning. In 2026, with constant notifications and market updates, this practice is more important than ever. Rule number 6. Assume you are a target. This rule is about security and psychology. As soon as you enter crypto, assume scammers exist who want your attention, trust, and access. This assumption doesn't make you paranoid. It makes you cautious. Safe beginners follow principles like never clicking links from messages claiming urgency, never sharing recovery phrases with anyone, never trusting guaranteed returns, verifying information from official sources. Only security is not about advanced tools. It's about habits. Rule number 7. Accept volatility as the cost of participation. Volatility is not a bug in crypto. It's the price of entry. Beginners who expect stability feel betrayed when prices swing. Beginners who expect movement stay calm. In 2026, crypto still experiences sharp ups and downs, often without clear reasons. The safest response is not reaction, but observation. When prices drop, instead of asking, "Should I sell now?" ask, "Did anything fundamentally change from when I decided to buy?" Often, the answer is no. Rule number 8. Progress slowly, intentionally. Crypto rewards patience more than speed. There is no finish line you must cross quickly. No one is grading you. A safe beginner path looks boring from the outside. It's slow, it's cautious. It involves reading, watching, and thinking more than acting. And that's exactly why it works. Now that you understand the rules and strategies, let's talk about how beginners actually get started in practice. Tools matter, but not because they're complex. They matter because the right tools reduce mistakes, friction, and emotional stress. In 2026, beginners have access to better designed crypto tools than ever before. The danger is not lack of options. The danger is choosing too many, too fast. So this section focuses on the minimum setup you need to start safely. Step 1. Choosing a beginner-friendly exchange. An exchange is where most beginners buy their first crypto. In 2026, safe beginner exchanges usually share these traits: strong regulatory presence in major regions, clear identity verification, simple interfaces, educational resources built in transparent fees. As a beginner, avoid platforms that promise unusually high rewards, push complex trading features immediately, rely heavily on referral hype. Your goal is not advanced trading. Your goal is clean execution and security. When you create an account, use a unique, strong password. Enable two-factor authentication immediately. Write down backup codes offline. This step feels boring, but it prevents devastating mistakes later. Step 2. Understanding wallets without overcomplicating. A wallet is where crypto is stored. Beginners often panic here, thinking they must understand everything immediately. You don't. In simple terms, exchange wallets are convenient but controlled by the platform. Personal wallets give you full control, but full responsibility. In early stages, many beginners start on an exchange wallet while learning. That's acceptable if you use strong security, keep amounts small, plan to move to a personal wallet later. Think of this as training wheels, not a permanent solution. Step 3. Making your first small purchase. Your first buy should be intentionally small, not symbolic, but small enough that mistakes won't hurt. When buying, Use market orders for simplicity. Ignore short-term price movement. Confirm transaction details before submitting. After buying, don't rush to do anything else. Sit with it. Watch how prices move. Learn how the app behaves. This observation phase is part of the process. Step 4. Basic tracking and awareness. You do not need advanced charts or analytics. Beginners only need awareness of total amount invested, awareness of long-term versus short-term intent, awareness of major news affecting crypto. Constant checking increases anxiety. Set limits for yourself, once a day, or even once a week. Step 5. First security upgrade. Once your comfort grows, learn how recovery phrases work. Practice moving a tiny amount to a personal wallet. Understand that mistakes are permanent. Never rush this step. Confidence comes from repetition, not speed. A simple beginner action plan. Summary. Choose one reputable exchange. Secure your account properly. Start with a small, non-stressful amount. Observe more than you act. Learn wallets slowly. Upgrade security over time. This plan is intentionally boring, and that's a good thing. By now you've seen the foundations, common mistakes, safe strategies, and practical tools for getting started in crypto. But if there's one thing that separates beginners who survive from those who burn out, it's emotional control. Crypto is a constant stress test, even in 2026. Prices swing 5 to 10% in a single day. Headlines shift overnight. FOMO, fear of missing out, whispers at every turn. If your emotions dictate your decisions, you will lose more than just money. You'll lose confidence. Emotional control, the beginner's secret weapon. Detach. Decisions from emotions. When prices drop, your first reaction might be panic. When they rise, greed may push you to overbuy. The solution is simple but hard. Pause before reacting. Step away from your phone, review your original plan, and ask, would I make this move if nothing had changed in my reasoning? Practice. Small losses. This may sound counterintuitive, but intentionally using small amounts to experience market swings teaches emotional resilience. In 2026, with easy access and instant trading, beginners who never experience a minor loss are often unprepared for real volatility. Controlled exposure builds muscle memory for calm decision-making. Set rules and stick to them. Earlier, we discussed writing down your rules. This is where it matters most. Your rules become anchors in emotional storms. If you plan to hold an asset for 6 months, don't sell because a headline triggers fear. Rules protect your logic from panic. Ignore the noise. Social media is filled with opinions, predictions, and hype. Beginners who constantly check feeds become reactive instead of proactive. In 2026, the noise is louder than ever. Allocate time to learn, but don't let it dictate trades. Your roadmap matters more than the latest trend. Building a long-term roadmap. To succeed safely, you need a plan that spans months and years, not days. Here's a practical roadmap for a beginner. Month 1-3, education and observation. Buy small, controlled amounts. Experiment with wallets and security. Track price movements without acting on them. Month 4-6, gradual exposure. Increase holdings slightly as confidence grows. Try recurring buys to automate discipline. Learn to read basic project fundamentals. White papers, team, adoption. Month 7-12, strategic experimentation. Introduce a limited intentional diversification test personal wallet transfers. Practice selling small portions to learn emotional control. Year 2 and beyond, consistent practice. Treat crypto as a long-term tool, not a lottery ticket. Reinvest learning gains, not emotions. Adjust strategy gradually as you understand risks better. The key is incremental growth. You're learning a system, not chasing profit. If you stick to a steady, deliberate approach, you reduce mistakes while building real understanding. Critical warnings. Even with preparation, crypto has risks that beginners must accept. Volatility is permanent. Prices can swing 50% or more in months. Expect it. Scams are still present. Even in 2026, phishing, fake apps, and pyramid schemes exist. Never share recovery phrases. No safety net. Blockchain transactions are mostly irreversible. Mistakes cost real money. Psychology matters more than tech. Overconfidence, panic, and impatience are more dangerous than most market risks. Acknowledging these risks up front does not discourage participation. It prepares you. Beginners who ignore these warnings are the same people who report being burned by crypto on social media. Those who respect them tend to survive and thrive. Conclusion and takeaways. Crypto in 2026 is no longer just a gamble. It's a tool for learning, investment, and financial independence, if approached correctly. Beginners who succeed share common habits. They start small and move intentionally. They stick to rules and written plans. They focus on learning over immediate profit. They manage their emotions, not the market. They invest only what they can afford to lose. Nothing here promises wealth. But what it does promise is sustainable growth in knowledge, confidence, and experience. That's far more valuable for a beginner than chasing the next viral coin. Call to action. If you're ready to take your first steps safely, pick a beginner-friendly exchange and create an account. Secure it with strong passwords and two-factor authentication. Buy a small amount of a well-established asset. Observe, learn, and repeat. Start slow, stay disciplined, and remember, crypto is a marathon, not a sprint. With patience, education, and emotional control, 2026 can be the year you build a strong, confident foundation in cryptocurrency without unnecessary risk. This is your first real step into the crypto world. Take it deliberately, and everything else becomes manageable.